Stop what you're doing right now. Tell your kids to stay quiet for the next 20 minutes or they're grounded. Tell everyone at home or at work, I'm watching John A. Do not interrupt me. Turn on airplane mode, because if you get distracted in the next 20 minutes, if you miss what I'm about to explain, you will regret it for the rest of your life. Are we clear? Good. Ladies and gentlemen, Asian guys here. Yesterday, Thursday, January 15th, something historic took place, something that hasn't happened in over 30 years. For the first time since the mid-1990s, central banks across the globe now hold more gold in their reserves than U.S. Treasury debt. Let me repeat that. Central banks now own more gold than U.S. dollars, more gold than U.S. bonds, more gold than American debt. This is the crossing of the Rubicon. This is the moment the U.S. dollar officially lost its monopoly as the global reserve currency. This is the moment the world quietly said, we no longer trust you. And if you don't understand what this means, if you don't grasp the consequences, you're about to receive a very expensive lesson. So be quiet. Pay attention. Let me explain exactly what just happened and why it means silver is about to surge to levels most people believe are impossible. We start with gold because gold is the foundation of everything that follows. For the past 50 years, ever since the Bretton Woods system collapsed in 1971, the U.S. dollar has been the world's reserve currency. Every nation holds dollars in reserve or holds U.S. Treasury bonds, American debt. Why? Because dollars are required to buy oil. Dollars are needed for global trade. Dollars are necessary because that's how the system was built. But there's a problem. The U.S. government keeps printing more dollars, debt keeps rising, deficits keep expanding, and the purchasing power of each dollar keeps shrinking. For years now, foreign nations have been uneasy. They've watched the U.S. government spend recklessly. They've watched the Federal Reserve print trillions to rescue banks. They've watched national debt climb from $10 trillion to $20 trillion to $30 trillion and now beyond $36 trillion. And they've been asking one question: how long can this continue? And more importantly, what happens when it doesn't? So quietly, gradually, over the last few years, they began to diversify. They started buying gold. China bought gold. Russia bought gold. India, Saudi Arabia, Turkey, Poland, all of them accumulated gold. And now, for the first time in 3 decades, the total gold held by central banks exceeds the amount of U.S. Treasury debt they hold in reserve. This is a massive shift. This is a global vote of no confidence in the U.S. dollar. This is the world saying, we don't trust your paper anymore. We want something real. And gold is real. Gold cannot be printed. Gold cannot be inflated away. Gold is neutral. No government controls it. It can't be sanctioned or seized. And that's exactly why it's attractive right now. Because the U.S. has weaponized the dollar. They froze Russia's dollar reserves when the Ukraine war began. They openly threatened China with the same treatment over Taiwan. The dollar has become a tool of political pressure. The rest of the world sees this, and they're scared. They're thinking, if they can freeze Russia's money, they can freeze ours too. So they're exiting. They're dumping treasuries. They're buying gold. And this marks the beginning of the end of dollar dominance. Now you might be thinking, okay, John, that's interesting. But what does this have to do with silver? Everything. Because when central banks abandon the dollar and move into gold, what do you think private investors will do? What do you think corporations will do? What do you think wealthy individuals will do? They follow the central banks. They buy gold and they buy silver because silver is gold's little brother. Silver is the working man's gold. Silver is the asset that moves 10 times faster than gold during a monetary crisis. And we are in a monetary crisis right now as you watch this. The people who understand this are buying silver aggressively, which brings us to what happened yesterday, Thursday, January 15th. Silver surged to $92 per ounce. $92, up from $30 just 6 months ago. That's a 200% move. That's the kind of move that creates massive wealth. But then something happened overnight. While Western markets were closed, the price collapsed. It dropped from $92 to $87 in just a few hours, a $5 fall in a thin, illiquid overnight market. When people woke up and checked their accounts, they saw red. They saw a 5% pullback and panicked. They thought, the rally is over? I should sell. But that's not what happened. That overnight crash wasn't a correction. It wasn't profit-taking. It was a survival maneuver by the banks. Let me explain. The major commercial banks, Bank of America, Citigroup, HSBC, JP Morgan, are massively short silver. They've been short for years. They sold paper contracts without owning the physical metal. Now prices are exploding higher, and they're bleeding money. Here are the numbers. According to the latest data, commercial banks are short roughly 4.4 billion ounces of silver, 4.4 billion ounces across all exchanges, contracts, and derivatives. At $90 per ounce, that short position equals $396 billion, nearly $400 billion. To put that in perspective, Bank of America's entire market cap is around $250 billion. Citigroup sits near $120 billion. If silver stays above $90 or moves to $100, losses on these short positions would exceed the total value of some of these banks. They wouldn't just be hurting, they would be insolvent. They would need a government rescue, and the banks know it. So what did they do? They panicked. They crushed the price overnight. They dumped huge volumes of paper contracts into the thin Asian and European sessions. They triggered stop losses. They forced margin calls on leveraged traders. They injected fear and chaos, and in doing so, they bought themselves time. But here's the critical point. They didn't solve anything. They only postponed the problem, because the fundamentals did not change. The physical shortage is still real. Industrial demand is still surging. The vaults are still being drained, and the price is going to rebound. And when it does, when silver breaks through $95 and pushes toward $100, the banks will be in even deeper trouble, because now they've exposed themselves. They've shown desperation, and desperate banks make reckless moves. Now let me show you the evidence that the physical shortage is real. While the paper price was smashed from $92 down to $87, something very telling happened in the physical market. Lease rates exploded upward. Let me explain what lease rates are. When someone needs to borrow physical silver, whether for industrial use or to cover a short position, they must pay a fee. That fee is called the lease rate. It's essentially an interest rate on borrowed metal. In a normal market, lease rates are extremely low, maybe 0.5% or 1% annually. Why? Because silver is plentiful. There's plenty of metal available. But that's not what's happening now. Right now, lease rates are spiking to 5%, 10%, even 15%. Some reports show lease rates reaching 20% in certain regions. Why? Because there is no metal available to borrow. The vaults are empty, physical silver is gone, and the people who need it are panicking. They're willing to pay 15% or 20% just to secure metal for a few months. This is called backwardation. It's when the spot price is higher than future prices. It's when buyers want the metal now, not 6 months from now. And backwardation is a massive warning sign. It's the market screaming that there's a shortage. So while the banks were busy smashing the paper price from $92 to $87 to make it look like the rally was finished, the physical market was shouting the opposite. Lease rates were saying, "We can't find metal. We need it urgently and we'll pay anything to get it." This is the disconnect. This is the proof that the paper price is fiction, and this is why the rally isn't over. It's only beginning. Now let me tell you what just happened in Shanghai, because Shanghai confirmed that we're entering the end game. Yesterday, Thursday, January 15th, the Shanghai Futures Exchange announced new position limits. They are cutting the maximum silver contract size from 7,000 lots down to 3,000 lots. That's a 57% reduction, effective starting the 9th trading session on January 19th. Why would they do this? Why would an exchange suddenly slash position limits in half? Because they are running out of physical silver. They're seeing delivery demands pile up. They're watching vault inventories collapse, and they're afraid they won't be able to meet their obligations. So they're forcing traders to deleverage. They're shrinking the size of allowable bets. They're trying to slow physical delivery demand. This is a soft intervention. This is the exchange admitting, we can't handle the volume. We need to slow this down before the system breaks. And if you don't think that matters, you're not paying attention. Shanghai is the largest physical silver exchange on the planet. It's where the real price is discovered. And if Shanghai is short on metal, that means the entire global market is short on metal. This is the endgame. This is the moment the paper market loses credibility and the physical market takes control. And when that happens, prices don't rise slowly. They explode. Now, let's address the elephant in the room. Yesterday, a rumor spread online. People claimed that Rick Rule, one of the most respected investors in precious metals, sold all of his silver. Panic followed. People thought, if Rick Rule is selling, should I sell too? Here's the truth. And it's very different from the rumor. Rick Rule did not sell all his silver. He sold roughly 80% of his physical silver holdings. Why? To take profits. He recovered his original capital, paid his capital gains taxes, and now holds the remaining 20% completely risk-free on house money. At the same time, he increased his exposure to silver mining stocks. He bought more producers and explorers. Why? Because miners offer leverage. If silver moves from $90 to $150, mining stocks could rise 300% or even 500%. Rick Rule is not bearish on silver. He's reducing risk and shifting into higher upside positions. That's what experienced investors do. They lock in gains, protect capital, and redeploy into assets with greater leverage. So if you saw the headline saying Rick Rule sold his silver and you panicked, you got played. The reality is far more nuanced. Even while taking profits, Rick Rule remains very bullish on silver. He simply moved exposure from physical metal to miners. That's not bearish, that's disciplined risk management. Now let me tell you about one of the most shocking forecasts I've heard in years. Vank, a major asset management firm, just released an updated gold price forecast, and it's staggering. They're using a valuation framework known as the Jim Sinclair model. It's named after Jim Sinclair, a legendary gold investor who accurately called the gold bull market of the 1970s. The model itself is straightforward. It takes the total money supply, M2, and divides it by the amount of gold held in reserve. The result represents the theoretical fair value of gold if gold were required to back the currency supply. Back in 2007, when Jim Sinclair updated this model, he projected gold would eventually reach $50,000 per ounce. At the time, gold was trading near $700. People said he was crazy, but his reasoning was solid. He said, if governments keep printing money, if deficits keep expanding, if debt keeps exploding, eventually the currency must be devalued. And when that happens, gold will be revalued to support the system. And that's exactly what happened. Gold climbed from $700 to $1,900 over the following years. It didn't reach $50,000, but the direction was correct. Now fast forward to 2026. Vank has updated the model using current data, and the new projection is staggering. $184,000 per ounce of gold. $184,000. Let me repeat that so it sinks in. Not $4,000, not $10,000. $184,000 per ounce. How is that possible? Because the money supply has exploded. US M2 is now over $21 trillion. Meanwhile, the US government holds roughly 260 million ounces of gold. Divide $21 trillion by 260 million ounces, and you get roughly $80,000 per ounce. And that's just using US data. Vank isn't stopping there. They're looking at the global money supply. And once you include the entire world, the number climbs much higher, to $184,000. Now, I'm not saying gold hits $184,000 next month. I'm not saying it happens in 2026. But I am saying the math exists. The framework exists. And if the monetary system fractures, if the dollar loses reserve status, if central banks are forced to reback currencies with gold, then $184,000 isn't insane. It's actually conservative. And if gold goes to $184,000, where does that leave silver? Historically, the gold to silver ratio has averaged around 15 to 1. That means 1 ounce of gold equals 15 ounces of silver. Using that ratio, $184,000 gold implies silver at roughly $12,260 per ounce, over $12,000. Now, I don't expect the ratio to tighten that much. In modern markets, it's been far wider. But even at a 60 to 1 ratio, where we were recently, silver would still trade around $3,067 per ounce. That's over 30 times today's price. So when I say silver targets of $300 or $500, I'm not being aggressive. I'm being conservative. The Vank model suggests the upside could be dramatically higher. Now let's connect all the dots because I want you to see the full picture. Central banks are abandoning the dollar and accumulating gold. Banks are short roughly 4.4 billion ounces of silver, facing potential losses near $396 billion. Shanghai is cutting position limits because physical metal is disappearing. Lease rates are exploding because there is no silver available. Rick Rule is shifting from physical metal into miners to increase leverage. And Vancy is projecting $184,000 gold, which mathematically implies multi-thousand-dollar silver. Every single signal is pointing in the same direction. The system is cracking, the monetary order is breaking down, and hard assets, gold and silver, are the only real refuge. So, what do you do? If you own physical silver, you hold. You don't sell because the price dipped from $92 to 87. You don't sell because of a Rick Rule rumor. You don't sell because a CNBC talking head says the rally is finished. You hold because the fundamentals are screaming. The end game is here, and prices are heading somewhere most people can't even imagine. If you own paper silver, ETFs, futures, derivatives, you need to seriously evaluate your risk. Because when the system breaks, when force majeure is declared, you could be cash settled at $87 while physical silver trades at $200. Ask yourself if that's a risk you're willing to take. And if you don't own silver at all, you need to buy it now, not next week, not after a dip to $70. Now. Because the window is closing, dealers are running out of inventory, mints are backed up for weeks, premiums are exploding. If you wait, you may not be able to get metal at any price. Now let me address those who believe the drop to $87 marks the beginning of a larger correction. Those who think silver is heading back to $75 or $70. You're wrong, and here's why. The dip to $87 wasn't driven by fundamentals. It was driven by manipulation. Banks crushed the price in a thin overnight market to buy themselves time and avoid insolvency. But they didn't fix the real problem. The physical shortage remains. Industrial demand is still growing. Vaults are still empty. Shanghai is still tightening limits. Lease rates are still surging. Nothing changed except the paper price. Paper prices can be manipulated. Physical reality cannot. So the price will rebound. It will recover. And when it does, it will rip through $92 like it never existed. Then it moves toward $100. And that's when the real panic begins. Because at $100, losses become unmanageable. At $100, bailouts are required. At $100, the system breaks. We will get there. Maybe not today, maybe not next week, but we will get there. And when we do, you'll be glad you held your silver. Now let me talk about timing, because everyone always asks me the same question. John, when does this happen? When does silver hit $100? When does force majeure arrive? I don't know the exact date. No one does. But I can tell you this, we are extremely close. The warning signs are everywhere. Shanghai is cutting position limits. Lease rates are exploding. Central banks are hoarding gold. Banks are staring at $396 billion in potential losses. These are endgame signals. My estimate, and it's only an estimate, is weeks, not years. Maybe a few months at most, but not years. The system is too fragile. The pressure is too intense. Something will break, and when it does, the price will move violently higher. So if you're waiting for the perfect entry, that time is now. Because by the time it becomes obvious to everyone else, it will already be too late. The metal will be gone, the price will be $200, and you'll be asking yourself why you didn't act when you had the opportunity. Now let me leave you with one final thought. The reason the banks are acting so desperately right now, the reason they smashed the price down to $87, is because they know what's coming. They know they can't hold the line much longer. They know the physical market is about to overwhelm the paper market. They know the squeeze is coming, and they are scared. And when your opponent is scared, when they start making reckless, desperate moves, that is not the time to fold. That is the time to hold. That is the moment to stand firm. That is when you look them straight in the eye and say, I'm not selling. So don't let a $5 dip shake you out. Don't let fake headlines or rumors scare you. Don't let overnight crashes in thin markets manipulate you. Hold your silver, trust the fundamentals, and wait for the inevitable moment when the paper market collapses and the physical price takes control, because that moment is coming. Central banks choosing gold over dollars proves it. Shanghai cutting position limits proves it. Spiking lease rates prove it. The $396 billion loss banks are facing proves it. Every signal is shouting the same message. The system is breaking, the endgame is here, and silver is about to launch. So hold the line, don't panic, don't sell, and prepare for the ride of a lifetime. This is John A.G. from Currency Archive. It is Friday, January 16th, 2026. Central banks just chose gold over dollars for the first time in 30 years. Banks face $396 billion in losses if silver reaches $100. Shanghai is tightening position limits. Lease rates are exploding. Rick Rule is shifting into miners for leverage, and Vank is forecasting $184,000 gold. The dip to $87 is a trap. It's the banks shaking the tree one last time before the breakout. Don't fall for it. Hold your silver. Targets are $300, $500, maybe far higher. Force majeure is coming. The endgame is here. Remember to like, subscribe, and share. Hold the line. Don't let them steal your future.